Well, let's get across the market open. Kyle Ryder joining us from capital.com. Kyle, great to have you back on the show. What were your observations of that session just gone? Bit of price exhaustion, election exhaustion?
Yeah, it sort of seems like an overdue pullback, frankly. More or less what we've seen over the last couple of weeks is a market that's really willing to climb that sort of wall of proverbial worry, and bucking off some of the really significant event risks that we have over the next few weeks. I mean, if you sort of list what we've got coming up, more or less, $14 trillion worth of the S&P 500's market cap reporting all next week in 5 companies. We've got the PC index running into a non-farm payrolls release. And then, of course, the week after that, we've got a Fed decision, which more than likely will see another interest rate cut, and that will come hot in the heels of the US presidential election. So when you consider how strong equity markets have been, and other sort of trades too that you can kind of see pull back last night, gold probably being the most conspicuous one, is that really we're starting to see the markets now reflect that uncertainty surrounding some of this event risk. And I dare say it may be a little bit of profit taking going to a little bit of cash as we wait out what is, truly quite a remarkable 2 weeks to have this level of sort of tier one, event risk on the calendar, basically all coming in at the same time.
You take a look at the election, and Kyle, certainly betting markets now putting the money on Donald Trump as the likely victor. Are we seeing that Trump trade gather some momentum there?
Yeah, absolutely. And, just doing my nightly sort of scrolling through social media, Jim Bianco, who's quite a prominent fixed income researcher in the United States, released this really interesting chart, effectively tracking the change in betting market odds for or against Trump, and overlaid that with the US 10-year yield. And the relationship is pretty stark in terms of how they've moved in lockstep over the last few weeks in particular. If you do look at some of the aggregate polling, and you certainly look at the aggregate, betting indicators, my favorite one is the Real Clear Politics one, a great aggregator. I mean, you're looking at betting markets implying that, Trump is a 60% chance of taking the election here. And if you look at all the major polling in the 7 or 8 battleground states that we'll be keeping an eye on, Trump's pulled ahead in all of those. And the kind of, detail in that too is that typically both the betting markets and the pollsters have underestimated Trump's performance in elections. So it makes you think that perhaps he's even further ahead than what's being implied by some of these metrics. So the markets are following that effectively. You're seeing that manifest in a sort of a steepening of the yield curve, a lift in long-term rates. That's that kind of trade on, fiscal deficits and higher inflation. But you're also seeing those old economy stocks sort of outperform. And up until the last couple of days as well, that kind of trade on gold has also been a big Trump trade. So again, cooling off a little bit last night, pulling back a little bit, but certainly the markets are positioning for a Trump victory.
So as you mentioned there, Kyle, those bond yields continuing to rise. Also, the US dollar. Interestingly too, I was just noting Goldman Sachs saying that the euro could fall by as much as 10% under a scenario where Trump does become president because, particularly of those hefty tariffs and tax cuts.
Yeah, and that's a major risk and a fairly reasonable one. Excuse me. I mean, if you look at 2 elements to that, one is what you just said, the trade wars and the fact that Europe's economy structurally is very, very weak. Tariffs would be a major blow, especially if it's to the sort of size, scale and breadth that has been proposed by Trump and likely members of his administration. But the other side of that too is just the clear signs of much stronger structural growth in the United States, even kind of independent of any kind of pro-cyclical measures that could come from the Trump administration in terms of fiscal spending. And, that's something that's been played out over the last few weeks with very resilient labor market data in the United States. And of course, still this disinflationary impulse that's coming through too because of high productivity. So that's all feeding that really strong growth narrative, those strong fundamentals in the United States. So for me, from a technical standpoint, actually, we saw a really significant test around 107.20 for the Euro USD last night, a bit of a bounce. That was where the lows were. We were probably up by about 30 or 40 pips by the end of the session. those sorts of notes from the likes of, say, Goldman Sachs sort of suggest that maybe we're due for a bit of a bounce, because it has been quite a rapid move. Technically, we're quite oversold. But again, in the bigger picture, we are certainly seeing a level of outperformance from the US economy, and on top of that, US economy or US dollar that should benefit, so to speak, and for lack of a better term, in any scenario where we see a tit for tat trade war emerge between the US, a Trump administration, and the Eurozone.
So, Kyle, locally, we are expecting a negative open for the Australian session. Look, little data to trade on. We do have some labour force data coming to us, but I guess the focus is very much on what's going on in the corporate sector at the moment. It is in the midst of AGM season, so we've got a lot coming to us today, plus quarterly production reports from the miners.
Yeah, certainly significant. The open this morning will be really interesting too, especially in the context of the sell-off we saw last night, which, has to be said, was very tech-driven. Again, you would imagine some positioning going into tech results next week, as well as that sort of jump in long-term rates, which obviously have a bigger impact on tech valuations, those sort of growth stocks, than they do in other areas of the market. It also should be mentioned as well that, and this could kind of change maybe the tone to trade as the session unfolds, is that we had Tesla's results much better than expected, up by about 8% in after hours. So maybe that will sort of shift the dial just on an intraday basis, and maybe support a bit of a rebound in US futures first and foremost today, but then obviously that'll bleed through into Asian markets. Otherwise, one does suspect that there might be a little bit of a focus on some of the flash PMI surveys we're getting across the world today, especially in the United States, because this will be probably the last picture we get about forward-looking indicators that we get about US inflation and US labour market strength before we get on Thursday and Friday next week the PCE index released, as well as non-farm payrolls. Again, it'll be kind of an assessment as to whether the US economy remains in that kind of very, very rare and precious Goldilocks zone or not. So that could be fairly influential as European and US trade unfolds. But again, the lead is fairly weak from Wall Street. It may be softened a little bit by some of Tesla's results today and the subsequent rally we've seen in the stock. But this is all happening, again, as we've said right off the top, in a market that now is factoring a little bit more of that uncertainty and heightened volatility going into what is going to be an extraordinarily busy 2 weeks for financial markets.